Hello traders, you're welcome to this video and you are welcome back to the Forex Geek channel. If you are new here, make sure to hit that like button and subscribe for more tips and strategies to help you improve your trading game. Now in this video, we are going to be diving deep into one of the most powerful tools in technical analysis, and that is the CCI Divergence strategy. Okay, if you are looking to spot market reversals and predict trends with accuracy, this is a video you don't want to miss. Okay, in this video I'm going to show you exactly how to use CCI Divergence to identify key turning points in the market. By the end of this video, you will have a solid understanding of how to apply this strategy to your own trading routine. Okay, so let us get started. Let me start by adding the CCI indicator to the chart. Okay, the commodity channel index. Here we go. All right, so what exactly is CCI divergence? All right, and why is it so important for traders? The commodity channel index is a momentum-based indicator that measures the difference between the current price and the average price over a period of time. Okay, we can see from the parameters, from the settings, the default period is 14. All right, so if you are trading on the 1 hour chart, it means the measurement is done over 14 hours, right? The past 14 hours. And then if you are trading on the daily time frame, it means the measurement is going to be done over the past 14 days. All right, or over 14 days. So it depends on the time frame. The period is 14, so it's over a 14 period. So that period now depends on the time frame you are on. If it is 1 hour, 14 hours. If it is daily, 14 days. If it is 1 minute, 14 minutes. All right, just to make it easy to understand. Now, the CCI divergence is the CCI divergence occurs when there is a difference between the price action on the chart and the movement of the CCI indicator. Okay, the CCI indicator itself is great for spotting overbought and oversold conditions in the market. All right, but now coming to divergence specifically, when the price is making new highs or lows, but the CCI is not confirming those moves, right? But the CCI is not confirming those moves, we have a divergence. Okay, this is a potential signal that the current trend may be weakening and a reversal could be on the way. Now, there are two main types of divergence. The first is bullish divergence. All right, the first is bullish divergence. So now, in the case of a bullish divergence, it happens when the price is making lower lows. All right, price is making lower lows, but the CCI is making higher lows. So this is a signal that the market may be ready to reverse to the upside. Now let's just look for a quick example of a bullish divergence. Okay, where we have price making lower lows, but we have the CCI making higher lows. Okay, I hope we can find such example real quick. All right, let us see this example right here. We can see the price was making lower lows here, and we can see that the CCI made higher lows here. All right, so this is an example of a bullish divergence. Okay, now when you want to trade the bullish divergence, after the divergence has been identified, what you have to do next is you look for a bullish candlestick pattern. All right, once the bullish candlestick pattern has been identified, for example, we can see that we had 2 consecutive bullish candles from here, and they were quite lengthy candles. So we could have considered entering a buy right after that, and then setting stop loss just below this low, right, this swing low, and then for our take profit, we can just wait for the CCI to get into the overbought territory and begin to point downwards. So perhaps we would have exited somewhere around here. All right, So once your bullish divergence has been spotted, you don't need to jump into the trade immediately, right? Look for a confirmation. For example, look for a chart pattern, okay? A bullish candlestick pattern or any other confirmation, right? Before you jump into the trade. Now, as for a bearish divergence, right? A bearish divergence occurs when the price is making higher highs, but the CCI is making lower highs, right? So basically, that is what the bearish divergence is, okay? So in this example, we can see that price made higher high here, and we can see that the CCI made lower high. All right, so this is what we call a bearish divergence. It occurs when price makes higher high, the indicator makes lower high. So we can see that just shortly afterwards, the price dropped. Okay, so if you want to trade this divergence, what you should have done was to wait for a bearish candlestick pattern. For example, you can see this bearish engulfing that formed. So after this bearish engulfing, you could have considered entering a sell around here, set stop loss right above the swing high, and then for our take profit, we would have just waited for the CCI to drop into the oversold territory and begin to point upwards. So we would have considered exiting our sell somewhere around here. Okay. Now, understanding this concept of divergence is crucial because it often marks the end of a trend and the beginning of a new one. Okay. So now that you know what divergence is, let us walk through the process of risk management. Okay, now that you've known how to make use of the divergence, okay, now that you've understood how to trade with the CCI divergence, let's talk about risk management. Okay, so I'm just going to use this example that is right in front of us. Once you enter a trade, ensure that you have already calculated your risk. All right, so if you are trading with a specific capital, make sure that your risk does not exceed 2% of your capital in one trade. Okay, for example, if you are trading with $100 account, 2% is $2, right? If you're trading with $1,000 account, 2% is $20. If it's a $10,000 account, 2% is $200, right? So, depending on the account size, make sure that you have calculated your lot size. Okay, so if you are trading with $10,000 account, for example, 2% being $200 means if this is your entry point and this is where your stop loss should be, you calculate how many pips. All right, once you've calculated how many pips, then you have to calculate what lot size will give you $200 for a risk of 130 pips. Once you've calculated that and you've gotten the lot size, that's the lot size that you will use to enter the trade. Okay, and then make sure that your risk to reward ratio is also good. All right, so you can use support levels to predict your take profit target. Okay, so you can use support levels to exit your sell. All right, or you can wait for the CCI to enter the oversold territory. But because when you are entering the trade, your CCI is not yet in the oversold territory, so you can just use the support level to predict your targets. So if you have entered that sell, or before you enter the sell, make sure that your risk to reward ratio is good enough, minimum of 1 to 2, please. So if your risk to reward ratio is up to 1 to 2, you can go ahead and enter that sell, set your stop loss, set your take profit, and you're good to go. Okay. So it's quite an easy strategy to use. But please make sure that you always get your confirmation. All right, you can use confirmations from candlestick patterns or chart patterns, or you can even use any other indicator of your choice to confirm your entries and your exits also. All right, it is very important. Okay. Now remember, divergence alone is not a foolproof signal. Okay, it's not a foolproof signal. It's not a foolproof signal that a reversal is imminent. And this strategy in itself is not foolproof. Okay, this strategy does not guarantee profit. All right, it does not guarantee profit, please. So make sure that you have that in mind. Okay, now let's talk about time frames. CCI divergence can be used on any time frame, but certain time frames tend to work better than others. Okay, so for short-term trading like scalping or day trading, you will want to use smaller time frames such as the 5 minutes or 15-minute charts. Divergence on these time frames can give you quick opportunities to catch short-term reversals. For longer-term trades, the 1 hour charts like the one I'm using currently, or 4 hour charts or daily charts are more reliable. Okay, divergence on these time frames often leads to stronger and longer lasting reversals. Of course, you should always tailor your time frame to the style of trading that you prefer. So just remember that the higher the time frame, the more significant the divergence and the stronger the potential reversal. Okay. Now, when using the CCI divergence strategy, there are a few common mistakes that traders make. Let us go over them so you can avoid them. The first is ignoring confirmation signals. As we discussed earlier, relying solely on CCI divergence is not enough. Always wait for confirmation from other technical indicators or price action patterns before acting on a trade. Secondly, trading against the trend. One of the most dangerous mistakes you can make is to trade against the prevailing trend. For example, you have this as a bullish trend and you're looking for a sell opportunity. That's not good, all right? It's not good. Divergence is a warning signal, but it's still better to trade in the direction of the overall trend for higher probability of success, all right? So when you want to trade reversals, okay, remember that divergence signals that a trend reversal is about to happen. So when you want to trade reversals, all right, trading the divergence strategy, make sure that you get your confirmation. Okay, that is the reason why I said you should make use of candlestick patterns, reversal candlestick patterns. Okay, reversal candlestick patterns. All right, before you go ahead to enter the trade. Now, thirdly, do not use too many indicators. Okay, while it is great to combine different tools with CCI divergence, do not overload your charts with too many indicators. Keep it simple and focus on the most important ones. All right, and then finally, do not, be impatient. Do not be impatient. Divergence always, doesn't always mean an immediate reversal. All right, in as much as divergence is effective, it works, but it doesn't mean that the reversal will happen immediately. Sometimes it takes time for the market to turn. So be patient and wait for the right setup. Now, to wrap it up, the CCI divergence strategy is a powerful tool for spotting potential market reversals. By identifying divergence between the price and the CCI, you can get an early warning of weakening trends and position yourself for profitable trades. Okay. However, remember that this strategy does not guarantee profit. So please, okay, it is not foolproof. And make sure to use this strategy with other confirming indicators and be patient with your entries. If you found this video helpful, please smash that like button, leave a comment below with your thoughts, and don't forget to subscribe for more in-depth trading strategies and tips. Thank you for watching, and I will see you in the next video. Happy trading.